welcome back, investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Georges Ugeux on the line. He is the founder of Galileo Global Advisors LLC. And Georges, I think you had the distinction of perhaps making one of the best calls or best, it wasn't really a recommendation, but talking about a stock, and that stock was Chubb, and you talked about the fundamentals, how you liked it, how it may be in play, and lo and behold, the stock was taken over the next day. Congratulations on that call.
Thank you.
All right, so no pressure on you today, but we'll have to see what you can come up with. I know you like to follow, the overall market, the macros, and everything that's going on. We've had, a discussion about interest rates going up here in September, data not really supporting it. Could you just give us your global view of the market?
Well, as far as the U.S. is concerned, I think it's high time that we have this interest rate change because there is a cost in not increasing interest rates, cost for investors, cost also for the economy. We need to have a decision. The Fed has been languishing on this decision for such a long time. So hopefully, at least in my forecast, in September the interest rates will increase and the pressure on the increase of interest rates will go down. That will be the right moment to reassess the market value. But there is another market that bothers me seriously, and this is not just an intellectual approach. I happen to be on the board of a company called AXA Tianping in Shanghai. This is an insurance company. It's owned by AXA, the French insurer, and by some Chinese investors. And I represent on the board the Chinese investors, and we have $1 billion of Chinese assets because insurance companies have to invest in Chinese assets. So I've been at the forefront of what is happening in China. And I think that it did have too much of an influence on the U.S. market. But I think what is happening in China is important in the sense that the limits of what the government can do have been shown both in the stock market and in the currency market. So I think we are going to go through a period of reassessment of that market, but nothing fairly dramatic after what happened already. The second thing I would like to say about the Chinese market is that everything was predictable. You know, when a market goes up 150% for no reason in 1 year, you kind of expect a correction, don't you? And when you do the correction and that correction leads to interest rates going down, you should expect the currency to go down because when interest rates go down, currencies go down. So what strikes me in today's market is everybody is rediscovering investment 101 because they believe that China doesn't answer the same kind of logic as we do.
Interesting point here. Just going back, we'll go to the Chinese market here in a second, but just going back to the insurance sector. Yesterday there was some chatter, there was a rumor that Travelers may be interested in Hartford Financial. Hartford has declined comment on that. Macquarie today said Travelers should focus on analytics and not consolidate. Any takes on the potential merger here between Travelers and Hartford?
I think it would be a big mistake because the combination of the two would put them probably under the scrutiny of the Federal Reserve, under the systemic financial institutions. So I think that those two insurance companies, of course, could do a lot of things together, but I don't think the time of consolidation is yet to come. We need to see which kind of global regulation we're going to have for the insurance industry, and that's not before next year. We also need to figure out how insurance companies in the world will react to the new regulation in Europe called Solvency II, which is also applying in Japan and in China and so on. So I think there is a period of uncertainty, and I would really be a little bit worried of seeing a consolidation happening now. That doesn't mean they won't do it, though.
Okay. All right, going back to the China market here, definitely dragging down the ADRs that, trade over here. Alibaba here, boy, oh boy, starting to get back towards its IPO price of $68. Disappointing earnings report here. It's just, the chart's ugly. The situation over there is hard to determine. Any take on Alibaba?
I think Alibaba is a stock that needs to be very well analyzed. And the problem that we had about Alibaba is everybody thought that because Jack Ma was a fun guy, he would be the best thing since sliced bread. The fundamentals are not there. With the correction, which is basically back to the situation of the IPO, which means that the bubble is gone, it's still trading at 46 times earnings. Now, the e-commerce market in China is definitely slowing down. Consumption will go down as a result of the last problem because a lot of people, remember, Chinese stocks are held 80% by individuals. So it's the households who lost money, and they are not going to consume just left and right. So you have that. You have a man who has obtained to be able to basically run the company without counterpart because of the multiple rights that he has, thanks to the U.S. regulation, which he couldn't get in Hong Kong or in China. And third, I mean, it's a guy who just said that the Third World War would be a good thing. So I'm starting to be really questioning the wisdom of the guy. And it's nice to be a wunderkind, but now he has to consolidate. So my view of Alibaba has always been extremely careful, and I never invested in it. So yes, I missed the bubble, but I'm very happy I didn't touch it.
Okay, all right. Moving on here to some other stocks here that are affected. China, Baidu. Any thoughts on Baidu?
The Baidu situation is much more solid because they have enough subscribers. And one thing that has been booming in the last month as a result, among other things, of the market situation is the social media. So Baidu is going to be a stock that I would continue to follow, the same as Tencent.
Okay. We got a question coming out of the chat here from Sheldon McIntyre, Hurt Capital, a frequent chatter, and asks really good questions. And he wants to know if you think the drop in the Malaysian, it looks like ringgit, indicate that the Southeast Asia is entering a 1997 type currency crisis.
It's not a currency crisis. A devaluation of 1.9%, which translates effectively into a decrease of the value of 3.5%. And by the way, today the renminbi was already going back to where it should be. I don't think it's a devaluation. There will be some adjustments, but it's clear that Malaysia has less solid fundamentals than China, and it needs China. Remember, Malaysia is a lot of Chinese people, so there is a lot of trade there. So Malaysia is basically adjusting. The devaluation of the renminbi was not a commercial decision. It's not a trade war like the Republicans want us to believe. The reality is it was the natural correction of a decrease in interest rates. And there were some capital outflows because the interest rates go down, as they always do. And so there was a correction done for monetary policy purpose by the central bank. It was absolutely not a trade war.
Okay. All right. So just moving over here, let's look at a couple other Chinese stocks here. The solar stock, Jinko Solar, I believe that got a spike off earnings. Any take on that issue?
No, I don't know them particularly. I know what happened to them, but I would not dare to comment on that one. I'm not familiar with them enough.
Okay. And we just have a few minutes here. We're on the line with Georges Ugeux. He's the founder of Galileo Global Advisors here. Just going back to the overall market here, we're within a couple percentage points of the all-time high. You have some stocks, some individual stocks is getting the beats on it. What do you think up at this level? Should investors be cautious here at this long consolidation period, or is this just a temporary stopping point on the way to new all-time highs?
I would take the market as it is today as an investor in the U.S. and globally as a neutral market, because we know that in September, October, we're going to have some events that are going to come. Some elections are coming down, but also hopefully the Fed will change interest rates. So I would certainly not be bullish, but that's not a reason necessarily to sell. If I can pick a stock, if you don't mind, that I've been following in the last few days, like every of us, and it's Alphabet. I was just mystified by the way the market reacted to the change from Google to Alphabet. because it's the first time in the history of mankind that all of a sudden people are happy because a company that is extremely well managed in the search engine and so on becomes a conglomerate, and they believe that that creates 6 or 7% of value. This transaction, Alphabet, is done for the founders. It's not done for the shareholders. There's nothing for the shareholders there, and there is even less for the employees, because being a Google shareholder is one thing, being an Alphabet shareholder is another one. So I am a little bit worried about the enthusiasm of Alphabet, and I'm certainly very suspicious of what the founders have tried to do here.
Yeah, very interesting take there. I was suspicious when they went to Goog and Google, but the stock has proved me wrong. We've been on the line with Georges Ugeux. He's the founder of Galileo Global Advisors, giving us a great look at the markets. Thanks a lot for coming on, Georges, and we'll talk to you again soon.
With great pleasure. Thanks very much.